Hey team, welcome back to the Dentist Invest podcast with familiar face Jon Doyle, IFA. We're here today to build on the podcast that we've been putting out recently and talk about asset allocation, which is super fun and super important. Jon, how are you?
Oh, I'm very good, thanks, mate. Yeah, very good.
Deja vu, isn't it?
It is a bit deja vu, although I've changed location. I'm at home today rather than the office.
Got you, got
Yeah,
you, got you, got you, got you. It looks a bit. The sun is flipping shining today. It's flipping lovely, which
sunny
is
Preston, mate.
that's
Sunny,
also changed. That is
sunny
also changed.
Preston. Yeah.
Lovely stuff.
It's the one day of the year we get sun in the north of England.
And it was a Friday this year. There we go.
Yeah.
Anyway, Jon, asset allocation. Let's hit the ground running. What the heck is asset allocation?
Okay, so asset allocation. Last week we talked about diversification being like the big rule in investments and managing risk in investments. Asset allocation is like the blend that we put together of all the different options of investments we might have. So the classic ones we think of are stocks or equities, so owning companies, and bonds, which is where we're lending money to a company or a government. But there's lots of other different asset classes that people will think about. Classic ones will be property, both commercial and buy-to-let real estate, residential. That's the word I'm looking for on a Friday afternoon. You've then also got things like commodities, gold, and you have investments in wheat and in grains. And then you get alternatives as well that can get thrown out there. There's investments in aeroplane leasing or in weather-based funds that trade off reinsurance. All sorts of weird and wonderful things people try to throw in there in the name of asset allocation. Yeah.
Yeah. Well, this I was going to say, that's news to me about the weather one, by the way. That's interesting. But even before I learned of that, within the last minute, it's obviously this huge subject, and you could probably write a flipping book on it. Yeah. So I suppose it might be helpful to have some focus today and state from the outset. Then, when we talk about asset allocations throughout the duration of this podcast, what we're really referring to are traditional assets, I suppose you could call them, or paper assets. What would be your label for those? Because I would call traditional assets stocks and bonds. I would call it that, and then anything outside of that is non-traditional, I suppose, right? Even though that it's not that they're new or anything, traditional in the sense that they're most used in financial planning, and they're the thing that is most recommended by IFAs whenever they have that conversation with their clients.
So if you came to and looked at like a Juniper portfolio, you're going to see stocks, you're going to see bonds, and you'll also will see some commercial property. Okay, so things like warehousing and offices and that sort of thing, because they're very traditional assets. They're very well researched. We've got a lot of data on how they perform in certain circumstances. Very liquid, very tradable. So they're very reliable in how they're going to behave. When you look at sort of the alternatives and other sort of things, there's a little bit more questionable as to the value they bring to a portfolio. I think sometimes they're just put in there to make it sound sexy.
Yeah, well, I wouldn't be surprised. Yeah, well, there's different labels for different categories of allocation, different categories of assets. But
Yeah.
yeah, I suppose for clarity today, what we're focusing on are stocks and bonds, right?
Primarily, we will just talk stocks and bonds. Absolutely. Yeah.
Lovely stuff. Okay, let's go one tier down. We've talked about asset allocation. Now we're
Mhm.
focusing on stocks and bonds. Naturally, part of the decision process in deciding how you allocate your wealth within a portfolio is related to how much exposure that you want to volatility, for example, how
Mhm.
much you want your assets to appreciate with time, or indeed just not be volatile. In which instance you might go for bonds, right? So, what is that maybe decision making process when you're thinking to yourself, okay, I've decided that I'm going to focus on stocks and bonds. Now I'm deciding how do I allocate my wealth into that portfolio.
So you would typically think about the amount of risk you're willing to take, the amount of risk you're financially able to take, and then the amount of risk you need to take in order to achieve the outcomes you're looking for. And the real tricky thing with this is when you're younger, and you're building your assets, you need to take more risk, but you maybe can't afford to take more risk. And so we have to think carefully about this. And as you get older and you build your wealth, you maybe need to take less risk, but can afford to take more risk. So it's a bit of a balancing act. And really, the biggest driver that we have in the decision that we make with clients is about how we feel their behavior might be affected by volatility in the markets, because that's going to have the biggest effect on our success when it comes to investing, is how we manage our emotions through market volatility. Okay, so if you're if you're someone who freaks out when you see your £100,000 portfolio drop to 99,999, then we're going to have issues, and we might dilute some of this down for you. If you're someone who really can live with it, you understand the process, you trust the process, you believe in the method of investing that you're looking at, then absolutely you'd look to dial the equities up. And the most return you're going to get over a longer time horizon is with a 100% equity portfolio. But we don't necessarily want to dive straight in there when we've not done anything else.
I get it. I totally get it. Okay, cool. And then let's go one level deeper, right? So let's use the 100% equities portfolio as the benchmark, out and out capital appreciation, right? So we've decided that we can stomach the volatility or the inverted commas risk. We're equating volatility for risk for the purposes of this, and
yeah, there are other risks, but that's the one that is commonly used for this. Yeah.
Indeed. So let's say we can stomach the volatility. And by the way, actually, just before we do this, 100% equities portfolio, right? S&P 500, 2007 to 2008, 50% of its value, right? That was people's life savings, right? So you're watching your million not go down by $1, but literally half, okay? Right? Yeah. And here's the thing, that's what you have to be prepared for as a 100% equities investor with a long time horizon, right? Now, that sounds in theory that you can manage it, and I'm sure people might hear that and be like, yeah, we can do it, right? But whenever you're watching your portfolio do that and you've got that sell button hanging right in front of you on your ISA app, okay, it's potentially a different story unless you understand the overall narrative and you trust the process, right? So that was just to give everybody a little bit of a flavor of how much that volatility can quite be. Yeah. But here's the thing, right? It all depends on perspective, because you might also say, oh, everything's half price, fire sale. Okay. But again, you have to understand financial markets to be able to perceive things like that.
Yeah. 100%. It's the journey. It's so easy to look at a graph and see the volatility and be like, oh yeah, that's not a problem, I completely understand. And then you can be two or 3 years into an investment process and still be where you were when you started, regardless of what investments you've picked. Sometimes that's just the way markets are. They go sideways for a bit, and you have to stick to the course. You have to understand the process you've picked and believe and trust in the process, and then know it's going to come out the other side. As an advisor, I've been doing this sort of 15 years now, and I've been through this process a few times. 2008-9, my first period as a financial planner, a financial advisor with clients. And so when you've been through it a few times, you know the rules for the road, because you've rehearsed it, you've planned it, you've lived it several times, and you're talking about it all day. But as a client or as an investor, it's a very, very different experience. This might be, if you're a dentist who just sold their practice in 2008, you pop it into the markets and then you've lost half your life's work. We're talking a very different feeling in that moment than maybe someone who's put a few quid into it just as they're getting started. So circumstance really matters, and it's about emotions and all that kind of stuff.
Totally. Okay, so that 100% equities portfolio, how do we allocate our wealth into equities is basically what is the next level to that.
Okay. So this guy called Harry Markowitz won a Nobel Prize for his work on modern portfolio theory. In this, it talks about having what's called a strategic asset allocation. So you look back over the course of history and you go, to achieve the kind of volatility I'm comfortable with, so the investment journey, based on the last 20 or 30 years, whatever your time period is, these are the asset classes I should have been in. And when we're talking equities, you're talking maybe US large cap, US small cap. You might be talking Asian equities, excluding Japan. You'll be talking about Japanese equities, UK equities, European equities, and maybe then even some more obscure stock markets, like in Brazil or not Russia maybe today, but those sorts of markets traditionally have been pulled into these portfolios, and you're allocating towards them. So for our clients, we tend to do this based on market cap. So the biggest allocation would be to the US, and then you sort of allocate your equity portions accordingly. Different portfolio managers, different investment managers have a different take on it. Some would include what's called a home bias, so they'd allocate more to the UK because we are UK investors. And so you maybe say, oh, we want to invest in sterling, so we'll have a UK exposure. But that piece of deciding where I want to invest my equities across these different markets would be the strategic asset allocation. Some portfolio managers and advisors believe then that they can make a prediction about what's going to come in the next 2 to 3 years, and might then make a tactical decision or active decision in that asset allocation process. So we'll go short on the US and long on the UK because we think that's what's going to play out for the benefit over the next few years. And they might do that with an index fund. So you can use these passive vehicles or index funds to make active decisions in your asset allocation. So that's kind of a little bit of a highlight into asset allocation. Typically you might start, if you start with the global market cap approach, you'd start with say 60% in US equities, 4% in UK, and et cetera, and then start to tweak it or dial it from there depending on your approach and theory on it.
Where do you stand in all of that?
We very much, I used to use a lot of tactical asset allocation. A previous firm I was at really believed in it as a process. But what I did was tracked the added value that these decisions were making, and generally found that they weren't adding a lot of value, but were adding cost to the portfolio. So it ended up pretty neutral. Even when they got it right, the additional cost probably wasn't worth it. And I think it's very, very difficult today to predict what's going to happen. We have global themes that you look and you go, rise of China, the demise of the dollar, Ray Dalio's work on that. You go, yeah, I can see that story happening, but I don't know when. And if you can predict when, you'll be a very rich man. And so what we tend to then do is look at a global market cap and have it on a systematic review, so that in a very processed and methodical way, we're reviewing this market cap, and then we'll rebalance the portfolio accordingly as we move forward. Okay. Now, I described asset allocation to clients in a bit like putting a slide under a microscope. We've started with stocks and bonds and how we might allocate. You can then, most microscopes have 3 or 4 lenses on them, mightn't they? I mean, it's a long time since I was in a science lab, but we spin it round and we look then at the asset allocation to countries. And we can spin it round again, and we can take, say, the US equity market, and then you can look at different factors or different characteristics of companies within that market again. Okay. And so there's a few different characteristics that may get looked at within a portfolio. One of the most common ones is large cap versus small cap. So we're talking there about the cap just means capitalization, like how much capital this company is worth. Large cap would be S&P 500. Small cap will be a lot of those companies that are not on there on the junior markets. They're still big companies. We're not talking about investing in mom and pop corner shop type stuff, as the Americans would call it. You know, still very large companies. One of the best known small caps in the UK would be like ASOS. It sits on the AIM market, or certainly did up until recently. I've not looked at ASOS for a while, but from memory, sits on the AIM market. And there's been quite a lot of research into what tends to outperform. And so, for example, smaller companies have tended to outperform larger companies in most market cycles. This last 6 years, not so, because of, you know, the FANGs and their sort of rise to prominence on the S&P. But typically, if we look back over 100 years of data, these smaller companies have outperformed larger companies. And so as a portfolio manager, you might say, well, we've got our 60% of US equities. How are we going to allocate this now to smaller companies versus larger companies? And then also there'll be other factors such as quality. So is this a really highly profitable company, or is it a growth company? Is it a company that just spits out cash, or is it quite capital intensive? So that's the quality area. You've got momentum as well. Like, is this company on a real drive somewhere? Are we seeing its share price do certain things on trading tables that you look at and charts that go, right, this has really got some momentum to it? And so there's quite a few different factors that can be looked at. Now, some of these factors have an awful lot of academic research gone into them. But then there are other factors that sometimes people will look at that maybe don't have the same rigorous levels of academic research going into them, because you can almost make a story of any sort of data point and bring a story out of it and call it a factor. Companies beginning with F, or with founders called Dave.
That's the thing, though, right? Because there's so many variables in there, and it's easy just to pick one off them and say, oh, well, that happened because of this, right? Well, if you're so good at predicting stuff, tell us what will happen, right? Rather than what has, right?
Yeah.
Especially in markets, because you can't predict this stuff. And to give you a quick anecdote on that, I was reading a book once, and the book was by a journalist, and he commented on financial markets, right? And his boss used to come in and say, hey, the markets are down today. Why the heck has that happened? And he'd be like, I don't know. They just are, right? And he was like, well, you better find a reason then, because we need a headline, okay?
Yeah.
You just make it up, right?
Yeah.
And the reality is no one knows.
And I tell you what, one fact is just come to mind. Have you heard of Jim Cramer?
I've heard the name, yes.
He does a show on, I think it's like CNBC or one of these sort of American things, and he's a stock picker, and he is notoriously bad at it. And if you watched Last Week Tonight with John Oliver, he did a big montage of Cramer's bad calls. You know, one of the most famous ones is him telling everyone that Bear Stearns was a buy 2 weeks before they went bust. He did the same with Silicon Valley Bank. There was a great one with Facebook where he, at the peak of Facebook's share price 12 months ago, he was calling it a buy. It's brilliant. They're geniuses. This meta thing is all what it's about, the metaverse. And obviously then the share price tanked to the point where 2 weeks after he recommended it as a sell, the share price inverted and it's since been on a rally, right? And some guy created an ETF called the inverse Cramer. So all it did is placed a trade opposite to whatever Jim Cramer picked. And I think it's got a Twitter account and everything, like the inverse Cramer, right? And it worked for a while. But it's now started to like not work so well because what happens is everyone plows money into the inverse Kramer, and suddenly it twists
Mm,
the logic or the theory behind that as a factor. But
that's
for a
hilarious.
while,
But here's the high level Jim Cramer play, okay?
yeah.
Jim Cramer is saying is going to do one thing, it's saying is going to go up, and he's flipping selling, you know what I mean? He's not buying. Jim Cramer is the real mastermind. That's what's happening.
He's playing 4D chess when the rest of us are playing drafts. Yeah.
100%, he is playing us. At least that could be what's going on. That could be plausible.
You,
Anyway.
you never know. You never know. So, different portfolio managers, different people will have different takes on the factors that are could be at play. But that's the kind of the next level of asset allocation. We tend to focus on small cap, on growth, on quality, and then you might look at throwing something like momentum in there as well, as a possibility. So you then allocate to these to try and produce a rounded portfolio. And I describe these factors to people as like taking that tin of Heroes or Quality Street, and which one do you tend to get at Christmas, Heroes or Quality Street?
Heroes.
Heroes. And what's always left at the end?
Oh, do you know what? I always get heroes and flipping celebrations mixed up. What's left at the end of the heroes? The heroes are the Cadbury's ones.
Or the celebrations, whichever one you're thinking of. I can't tell the difference between the two.
Yeah, the issue is I don't actually know which one's which. But anyway, I'm pretty sure heroes are the Cadbury's ones. In which case, it's those caramel ones. They're always left.
They're the ones that are left. Yeah.
Yeah, they're
I
horrible.
probably think celebration, and it's always the bounty in our house.
Oh, what?
Yeah, yeah,
Really?
yeah.
They're the first
Yeah.
to go
Oh,
here.
okay, that's great. But the one that in the tin of roses or Quality Streets, the toffee coin, right?
Mm,
No one
who
goes for the
eats
toffee.
those?
Right, exactly. And using these factors is like taking an approach to these sweets for chocolatiness and sweetness and crispiness and softness, and you just end up all you're excluding is all the toffee coins at the end, right? Because you're just getting rid of the ones that actually no one wanted in the first place. There are a lot of zombie companies that just move on. So by blending these factors together, you can kind of dice up the market and end up with a much better investment experience, tilt it in your advantage. And that's just one way of kind of taking, stocks and bonds, then into global asset allocation and where we're allocating around the world, and then onto the factors that might be at play within a portfolio.
You know, the sign of an effective analogy is one that everyone can relate to and totally understands, and that actually really works. But
Yeah,
anyway,
I love
okay,
analogies. It's like
it
my
really
favorite
works.
thing.
It's a really good one. Anyway, stocks. Okay, so we've investigated stocks under a magnifying glass. What
Yeah.
about if we want to do the same for bonds?
Yeah, again, so there's a few things with bonds. I've got some slides to my left here if people are watching this on anything, because some of this stuff is so detailed, I can't do it from memory, especially on a Friday night. Okay.
Let's go.
But when it comes to bonds, there's a few things that really impact it. Again, you would make a decision about what global asset allocation you're going to take with your bonds, and also the allocation between company debt and government debt, because they have different characteristics. Okay. So, for example, with Juniper, we focus on UK debt because we don't want any credit risk, not any credit risk, any currency risk in this part. Our view on bonds is it's there like the tonic in a gin and tonic. Sole job is just to take the kick out of your equities. Nobody wants it on its own, apart from my 12-year-old who will drink tonic on her own.
Oh, see, right. That analogy, right, mightn't quite work because the gin is the fun part of the tonic, John.
Yeah, that's the equity. The equity
Oh,
is the fun
oh, right.
part.
Oh, sorry. Oh, sorry.
Yeah, 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 yeah.
I'm completely misunderstood.
No,
No.
no, no. So equity is the fun part,
Ah,
and the tonic just takes the kit off, right? So
right,
you
right,
know,
right, 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 right,
you
right.
don't want to get drunk too quickly, so you have a bit of a tonic. You might have a single instead of a double, or
Oh, okay. But you have to have some fun, right? And therefore there usually is a little bit of gin in there, right?
because
So you
nobody
need
drinks
some fun.
tonic on its own.
Hmm. Okay, I'm getting way too sucked into this. Sorry,
Yeah, yeah.
I misunderstood. So I'm gonna check out off the gin and tonic analogy.
Don't
Sorry
worry,
about
don't
that.
worry.
Sorry about
It's fine. It's fine.
that.
So anyway, you can look at um, a global allocation. You might look at some US bonds. If you're wanting a higher yield on it, you might push into sort of high yield debt, or some countries that have much higher yields on their bonds. There was a point in 2013, I think, when the yield on a Greek bond reached 110%, because nobody believed that they would be there in 12 months to pay back that debt. Not the kind of play that I would go for, because I don't think our excitement should come in from the bonds. But so that's that first decision: is what bonds do I want, and what countries are we going to go to for that? Okay, and this is where that decision of actually what is the purpose of bonds in your portfolio? Are you looking for income? Are you someone who's investing in bonds to get natural income to pay for stuff? Or are they a diluter to your big equity portfolio? And then we have term, so the length of the bond. So you can get these long dated bonds. Some governments have issued bonds that are like 100 years long, and you get really short dated. So you can buy bonds that are just in the last 1 to 3 years of their term. And that term is a really big, important part of the return of a bond. And then credit. So how credit worthy is the country or company that you're lending money to? The US, very, very credit worthy. Argentina, not so credit worthy, got a bit of a history of defaulting on debt. And this will then play into the risk profile or the volatility that you could expect, and the returns that you would expect from a bond portfolio. Give you an example. All right, now I'm going to use an analogy that's a bit visual, but hopefully people can picture it in their mind. Is this term and yield are like two ends of a seesaw, right? And the capital value and the interest rate on a bond are like two ends of the seesaw, and term is like the distance you're sat from the fulcrum, or from the middle of that seesaw. So if you've got a really long dated bond, the capital value is going to go up and down quite significantly as the yield changes, because £100 bond paying £4 a year is a 4% yield. But if everyone suddenly wants 8% for their bond, well, your bond's now only worth 50 quid. And that's what happened when Liz Truss took over. Interest rates went from 0.5% to 3 or 4%, and suddenly bond yields dropped significantly. But if you're short dated, if you're sitting really near to that middle of your bond with the term, in the middle of the seesaw, you're not going to experience as much volatility, because you know you're going to get your principal, your 100 quid back,
Yes,
1 to 3 years.
that
Okay.
makes sense. Yeah.
So it makes a really big difference to your experience as an investor. And this last 12 months, bonds are supposed to be the tonic, right? They're supposed to be the boring bit, low volatility, take risk off the table, all that kind of stuff. But there's a whole swathe of investors over this last 12 months who've been sat in long dated bonds. Some of them put there automatically by their pension funds or by their advisors, who have been sitting on 30%, 40% losses because they were in long dated bonds, and it's been catastrophic. So bonds like the term, the credit worthiness, really important things to think about with your bonds. And are you looking just for something to take risk off the table, in which case, like we do at Juniper, we just stick to short dated UK bonds, or are we looking for something that's going to add a bit more spice in there and get some interest, some yield from our bonds, and maybe even some currency risk by having Japanese bonds or US bonds, etc.
Okay, cool. So there's a little bit
Got heavy
of,
there.
pardon, sorry.
We got heavy there.
It's no, it's good because it's proper meaty stuff that is full of, well, it's interesting, isn't it? We can dig our teeth into. So when it comes to bonds, it's a little bit more calculated, is it? The decision to buy bonds versus equities. There's a little bit more, few more things you have to consider. Is that a good way of putting it?
Yeah. Well, also like bonds can be a lot more scientific. They're very predictable because you know what your yield is and you know what your term is when you buy the thing. So they can be quite predictable, and you can model what will happen in certain environments. So you really want to be buying bond funds that are going to do what you expect them to do if you want to be in bonds.
I like it. So when it comes to let's say purchasing an ETF which will give us exposure to the global economy and which is some people's entire portfolio if they're 100% equities, right?
Yeah.
And that's fine, and on a level that works when your time horizon is extremely long and you can handle the volatility, right? The second we start to put bonds in there, because it's a more involved process. Let's say people are thinking about divesting, okay, and they're getting to that realm where we're thinking, okay, because traditionally the logic would be if you're 10 years, and tell me if you agree with this, right? But traditionally the logic would be when you're outside of 10 years of having to touch your principal, as in your assets, right? Then the traditional logic would be that where volatility is not a consideration and emotional factor not a consideration, we're 100% equities, right?
Mm.
Yeah. So as soon as we get within that 10 years and we're thinking, okay, divesting is on the horizon, okay, now what we need to do is smoothly start to withdraw some of the value of this portfolio and turn it into cash, right? So we're going to use bonds as like a halfway house, okay? Yeah. So the second that we start to purchase bonds, right, because there's a few more intricacies to it, is that something that realistically a retail investor could do? Or would you advise getting some help from a professional at that point?
I mean, I'm a financial advisor. I most people I think would benefit from
Yeah.
taking actual financial advice on these things.
Yeah.
I think, interestingly, on a total market cap fund, whether it's an ETF, you're still only getting, although it's called a total market cap, you're still only going to get 35-40% of the global companies in something like that, because often they can still get enough tracking error of the global market without touching some of the smaller, more illiquid companies that they can't get involved in. So you can improve your output by taking a more siloed approach to investing in different markets. So it's a good starting place to be, but then there's more nuanced ways to go about doing it. But then when you're looking at bringing some risk off the table into bonds, there are ways to go about doing it as a DIY investor. But I think the bigger thing with this is the cost of mistakes, gets much bigger to recover from. Right?
Yeah.
If you're in your 20s or 30s and you've put 10 grand into a total market cap fund and it drops 50%, and you've got 30-40 years, whatever, to recover from that, and it's only 5 grand. You're coming into land at retirement the cost of a mistake, one, you are going to be talking hopefully more significant numbers, and like your £1 million example right at the beginning, we dropped 50% on £1 million portfolio. If you lost half your portfolio, how do you recover from that? Right, it's very, very difficult. You don't have the same earning capacity. Interestingly, time horizon probably hasn't changed too much.
Go.
So that's really interesting, and I think obviously as an advisor, I'd suggest that everybody would gain value from talking to a professional advisor at any point through their journey, because even a total market cap fund isn't going to capture the whole of the market. They'll sort of capture, say, like 40% of global companies, and it does enough of a job to manage without a tracking error. But certainly, as you're coming in towards retirement, things start to get real, because the cost of a mistake and your ability to recover from a mistake becomes much harder. The cost is bigger and it becomes harder to recover. If you're sort of 20, 25, 30 years old or whatever, and you lose 50% of your portfolio in global equities, or you're stuck in long dated bonds when Liz Truss took over, and you lost 50%, it's not a problem. You've got 30 years to recover, and it probably was a relatively small amount of money in the scheme of your life's earnings. But if you're 55, 60, just sold your practice, you've got your lifetime of pension savings and stocks and shares ISA savings, and we're sitting on a 7-figure sum, and we get it wrong, that's your years worth of work gone, and years that you don't have ahead of you to work and earn back that mistake. So it gets really important to manage that. And although you can go out and DIY bond investments, I think the process of really thinking through the risks you're willing to take, not willing to take, where you feel exposed, thinking about what you want to achieve over the next 20, 30, 40 years of your life. That's where the power of financial planning and advice will come in, because you can then slot your portfolio into this and take risks that are appropriate for what you're trying to achieve over the course of that. And I think that the old wisdom is now out of date on this. Right? The old wisdom was that you would, drastically reduce risk at 60, and maybe even buy an annuity. Right? Now, annuities are dead. Even now that interest rates are high, I think the yield you'd get on annuity is about 3.5% on an index-linked annuity, right? So why would you hand over 100 grand to get 3.5 grand a year? You're going to be 88 before you get your money back, right? So the wisdom is different, but also longevity is really starting to impact this, right? There's a really interesting stat. I use JP Morgan's Guide to Markets quite a lot for some of this research. It's a free app on you can get on iPhone and iPad, really useful to download. In their most recent slide, they've got one on life expectancy in the UK. Okay, and if you're 65, I'm going to ask you to guess this, right? If you're 65 and you're a man, what percentage chance do you think you've got of living to 80?
Well, I mean, I'm actually roughly au fait with average life expectancy figures. So that would be 82 for men-ish. So let's work off that if it's roughly that.
Yeah.
So if you've already made it to 65, your chances of making it to 82 would presumably be higher, because I'm sure there's probably a lot of people who die from memory. There's a lot of people who die young, and then people tend to survive, and then they, as life expectancy comes up, that death rate increases again. So I suppose the answer, if that's the average, if 50% is the average, okay, then you'd say 50% would make it there, okay, right, by logic, but then it would be slightly higher because they're already 62 is my logic. So I'm going to guess 55.
67%. Yeah.
Okay. Oh, the logic was there, though.
The logic was
The
there.
logic
And
was there, though.
for women, it's 76.
Okay.
Uh, but when you look at it for a couple, for one member of that couple to live to age 80, what do you think the percentage is?
One member of the couple to live to age 80.
Yeah.
And what was there a qualifying factor there? Were they already 65?
Yeah, yeah.
So oh, I'm not even going to try to logic this one. I'm just going to pull an answer out of the air. I'm going to say 70.
No, it's 92%,
Oh, okay.
which is crazy. Now let's push this out to 90. All right. What percentage of men who are 65 will live to 90?
65 will live to 90. Well, it'll definitely be lower than whatever we said a minute ago. 64, was it? 90, I'm going to guess 43.
No, it's 24%.
The 43 is a bit high, really, isn't it?
Yeah, 43
I
is a
should
bit
have
high.
thought about that.
Yeah, yeah. So one in four men who are 65 will live to the age of 90. What about women?
Well, women live longer than men, so 1 in 3.
Yeah, pretty close, 35%. That's a
There we
very
are.
good guess. Yeah, yeah, yeah. And a couple, final one. A couple. What percentage of a couple will have one person live to the age of 90?
So presumably it would be somewhere between 1/3 and a quarter, right?
Think about what happened in the last one. Yeah.
Oh yeah, it went crazy high, didn't it? Okay, 55.
51%. Yeah.
Okay.
Yeah,
Oh
yeah.
yeah, because of course it wouldn't be between them. It would be we've got two
Yeah,
people.
yeah,
Oh,
yeah,
right.
yeah,
Okay.
yeah, yeah.
Got you.
It's the weird way the things statistic to a head. But if you think like 65-year-old couple, most people marry someone within sort of 5 years. Let's say 65 and you're retiring. There's a 50-50 chance one of you is going to live to 90. That's 25 years. So
Wow.
why would you invest over the short term?
And people are living longer.
Yeah.
People
And
who listen to this podcast,
yeah.
average age 25 to 35. So the stats say.
And what you also then will add into this is, I live in the northwest. Blackpool is just down the road. City centre Blackpool, life expectancy is 55 for men.
No
Yeah.
way.
Because of it has this whole thing of like a lot of people with very difficult backgrounds went on holiday to Blackpool in the 70s when they were kids. So you get a lot of drug addicts migrating there to live out their days. So their life expectancy is atrocious. It's just atrocious. But most of the people listening to this podcast will be above average health, above average wealth, living in above average areas. They're above average people, so they're going to live typically longer than the average person. So it becomes really important that we don't de-risk too much in those early years, but also we don't try and have this static income. So that's where like asset allocation becomes really important in the way we want to live our life through what could be 100 years of living.
Food for thought. John, thank you so much for all your wisdom today. Coming up to the 40-ish minute mark. I like to keep things around about then for conciseness. Any words of wisdom just to round off?
No, not at all. If this has sparked anyone's interest, we've got some more stuff that we can send to people. So if you've got any questions or want to dive deeper into this, you can reach out to me, Juniper John on Instagram and Twitter, at Juniper Wealth UK, I think on most social media, and juniperwealth.co.uk is our website. So just here to serve.
Top stuff. Thanks so much, John. Hope you have a lovely Friday and a lovely weekend. We'll speak to each other very soon.
Awesome, mate. Catch you in a bit.